This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Stock prices can lead the economy by 6 months or even more, but this time around, they're almost ignoring emerging cracks in the economy altogether and seem more focused on improving tariff visibility than the actual effects. Be careful thinking the markets have it wrong, but at least the margin for error has likely shrunk. Up next, let's dive deeper and try to make some sense. Welcome on board another edition of our Wise Investor Group podcast. I'm Simon Hamilton, Managing Director at the Wise Investor Group of Raymond James. Very glad to be with you. Had a chance to get down to the beach with my family, southern tip of Virginia Beach, Sandbridge, which is a lovely spot. Hopefully you, your family, your friends have been able to take a little time off. Of course, the markets haven't taken any time off, nor has the news flow or the headlines. Normally, if you've been listening to me for a long time, I don't like to spend a ton of time on the macroeconomic picture, mainly because, as I've talked about for years, the market doesn't equal the economy, and the economy doesn't equal the market. They are rarely in sync, and focusing too much on the current data can often lead you to miss the plot, because maybe you don't realize that the market's already 6 months out in front of what you're seeing. But this time around, there's a lot going on, right? I mean, we have mixed data signals. We know that. We also know that the tariffs, some of which just went into place this week, will work with a lag, and really the impacts we don't know yet. We saw some jobs data a week ago that was downright awful. And there's outright questioning, of course, of the data by the Trump administration. So with all this going on, I thought I'd do a little bit more to explain or discuss kind of what we're watching, what we think are the most salient things to keep an eye on, just to hopefully clear the air a bit. There's so much infusion of political rhetoric and headlines and Trump this, Democrats that it's very easy to get lost in all of it. So hopefully I can shed a little bit of light. There have been some questions, open questions that I've had, some of which, actually most of which I've shared, in talking to you over the course of the last few months, some of which we're starting to get some answers to, some of which are still very much open questions. We talked earlier in the year about the significant decline in the so-called soft data, sentiment data. Consumer sentiment data in particular had really rolled over and gotten negative. And yes, it was somewhat along partisan lines, party lines, but it really, in aggregate, it had gotten worse. And the open question was, is that going to morph into a slippage in the hard data, i.e. what people actually do with their money? And that's starting to get answered a little bit. We're starting to see some softer data, so I wanted to talk about that. We talked about whether there will be or would there be a sort of a give back of some of the economic activity we saw earlier in the year. We thought that knowing that tariffs were coming, a lot of consumers, a lot of businesses were making a lot of purchases, pulling in inventory ahead of those price increases. Inevitably, that would lead to slower data on the other side of that. We're also starting to see that. So those two questions, I won't say that they've been answered, but we're starting to see more evidence of an answer. Let's put it that way. I think the open questions going forward are, is this an actual economic downturn that we're seeing, or is it just the result of uncertainty? In other words, as a nation, consumers, businesses, what have you, are we all sort of collectively sitting on our wallets, our purses, wondering what's going to happen? And of course, that in and of itself can lead to an economic slowdown. But the flip side of that is once we do get some quote-unquote certainty, some resolutions, some actual tariff rates, can companies, can individuals go back to saying, okay, we kind of know the landscape now, we're going to start hiring, building warehouses, buying software? Open question. We don't know yet. Related to that, like I said, is this just a soft patch or something more pernicious? And then the other thing that we're starting to see, how much dispersion is there going to be in how companies and sectors react to tariffs, not only react to tariffs, but are impacted by tariffs? Started to see some pretty good evidence of that from these second quarter earnings reports, so we'll talk about that as well. So those are some of the things. David Kelly, who's the chief global strategist at JP Morgan, a guy I've followed for a long time, he said this week, quote, "I think there's a disconnect between the superlative performance of the U.S. equity market and the mediocrity of the American economy." Well, that's probably a good way to put it, because the economic data is not great right now. It's been resilient for the most part, but the economic data is definitely showing some cracks. To wit, last Friday, a week ago's employment report was pretty darn awful, right? We had seen a June jobs report that spurred a narrative of kind of stabilization in the labor markets. Well, July reversed that. And as the folks at Natixis put it this week, the narrative pendulum has swung back aggressively and downside risks to labor markets are back on the menu. Okay, so that's kind of what's going on, because not only was the July jobs report soft, we saw a significant negative revision in the prior 2 months, to the extent where the labor market has stalled completely. I mean, we're only seeing 0.02% growth per month over the past 3 months. And remember, this had been a pillar of strength. I've talked a lot about this on the podcast, how the consumer spending in the face of tariff uncertainty was still pretty strong. But, you know, if the labor markets are softening, we definitely have to watch, to what impact that will have on consumer spending. Remember, back in 2022, when a lot of people thought that a recession was coming in the face of the Fed tightening rates, well, one of the reasons the recession never transpired is because the unemployment rate never went up. People still had jobs. So despite all the inflation, people still had jobs, and if people had jobs, they were still spending, even if they were paying higher prices. So that's something we're going to be watching very closely going forward, okay? And lest you think, there are a lot of people, again, this is along political and party lines, but Trump has openly questioned the data, of course, firing the BLS head who's been in place for some time, who, by the way, the Trump administration praised earlier this year when the data was good. Don't forget that. I'm not going to wallow into the political mire here, but what I can tell you is these lousy job numbers have been corroborated by other similar surveys that have nothing to do with the BLS. So, for example, the private sector, which actually is a good thing to watch because it's less influenced by government spending and regulation, DOGE, that type of thing. It's more kind of pure data, I would say. That's been softening for 3 months. And if you look at the ADP figures, which I also follow pretty closely, they've also suggested a pretty significant slowdown in hiring. So, again, I would not buy too much into the political rhetoric. The data says that things are slowing. Now, I will say at this point, it's been more about less hiring and less jobs available than actual firing, actual layoffs. So we'll see if one is a precursor to the other. Hopefully not. Okay, but bears watching. And that was kind of followed up this week by more concerning data, not to pile on, but it's just the reality. The PMI, Purchasing Managers Index, there's a manufacturing component to that and a services component to that. Arguably the most reliable aggregate survey of economic activity. Certainly much more reliable than like GDP and other figures. And it slipped in July. 50 is sort of the demarcation level. Above 50 indicates expansion, below 50 contraction. Well, it slipped from 50.8 in June to 50.1 in July. That's the lowest reading in, quite some time. I don't have the exact date, but quite some time. And remember, services make up 70% of the U.S. economy, so a slippage in the service sector is not a good thing. I'm not going to get too much more into some of the economic headlines of the last few days, but I will say don't pay a whole lot of attention to the GDP figure. A lot of economists were touting how strong GDP was in the second quarter, over 3%, but it was really just a pullback. Okay, remember, anticipation of higher tariffs, as I was saying a couple minutes ago, led to a double-digit front-loading in imports in the first quarter. Companies, wanted to stockpile ahead of higher prices. And a nearly commensurate decline in imports in the second quarter. In contrast, exports barely budged in both quarters. So As a result, net exports, not to get too much into the weeds here, but net exports, which is exports minus imports, subtracted about 4.5 percentage points from real GDP in the first quarter, which was more than made up for by about a 5 percentage point positive contribution in the second quarter. So it's that give back that I was talking about. And by the way, FactSet is where that came from. But, if you filter out the kind of import-export trade-related tariff noise, consumer spending, the main engine of the U.S. economy, rose at 1.4%. That is the slowest expansion that we've seen in quite some time, and about a quarter of what we saw last year. So that's a big deal. Core GDP growth, what actually counts, consumer spending as well as core CapEx, by the way, core capital expenditures. They're not in contraction mode, but very close to stall speed. So the slowdown in the economy is inarguable. Obviously, what we need to see is where it goes from here, and that's why I framed that question earlier in the podcast. Is this just a pause, the result of us kind of waiting to see what happens? And now that we have at least some more clarity on certain tariff rates, will that unlock some spending? We'll see over the next couple of quarters. We know that we are not done with trade taxes, right? This week was eventful again. The rationale for tariffs seems to shift. The narrative du jour, if you will, is it a punitive thing based on if you are doing business with Russia. So President Trump wants to hammer out something with Putin and put an end to the war with the Ukraine, and to sort of ratchet up that pressure, he is putting economic pressure, quite frankly, on some of our allies. So the most recent thing was this week, India putting a 25% tariff surcharge on their imports, so that's up to 50%. Why? Because the Trump administration claims they are importing too much oil from Russia. So, the weighted average tariff rate now, and this is, by the way, before we've really heard about pharmaceutical tariffs, the weighted average tariff is up to about 15%. That's 7 times higher than what we saw in January. So we know that tariff revenue will bring money into the government. Looks like it's about an extra $20 billion in each of the past 2 months, so the run rate is close to $250 billion that will be coming into the Treasury. And of course, it wasn't widely publicized, but that was one of the things that was used as a rationale for, some of the tax bill, some of the spending in the tax bill, that this tariff revenue would help plug some of those holes. But the bigger question is, we still don't know who's paying the tariffs. It's a mixed story. It's very much a mixed story. And, certainly we're seeing a dispersion from industry to industry, company to company. Automobiles, for example, there just isn't a lot of demand right now to justify charging higher rates. So the Fords and the GMs of the world, they can't really raise their prices, so they're taking big hits to their earnings. Meanwhile, some of the high-margin tech companies have been a lot less vulnerable so far. In fact, they barely pointed to tariffs as much of a risk at all. So I think ultimately the way you kind of think of this is there are 2 key factors. There's consumer demand. Weak demand means less pricing power. So companies that do not have a lot of demand for their products, or if it's a product that can be a kind of exchange for something else, they have to absorb the cost or risk losing customers. And then there's exporter supply. That's the other big factor. Data shows that retailers more often eat tariff costs than exporters of machines, for example, which require more intricate work, quality control, leaving exporters in a more powerful position with respect to pricing. So, I don't want to get too much into the nuance of that, but I think what we found from this second quarter earnings report season is that there is I've used the word dispersion a few times, there's a wide dispersion in who is navigating this and who isn't, which I think really argues for investment selectivity going forward, right? And a good understanding of the kind of the business behind the stock price, okay? And the other thing, of course, like I said earlier, is that it's likely that we won't see the full impact of these tariffs till later in the year, maybe even 2026. So it's going to be an open, conversation. I will say that according to Goldman Sachs, the majority of tariff-related costs will be paid by consumers. They estimate over 70% of that. But what we've seen so far is that the market has been reacting less to the actual tariff level, more to the fact that we're starting to get some deals done, right? And some certainty, if you will, some clarification around the tariff rates. So again, as I mentioned earlier, maybe it's less to do with the actual tariff rates and more to do with just economic activity stalled out in the face of uncertainty. So if companies are free to spend again, if consumers feel more comfortable spending, maybe that unleashes some economic activity. We'll see. Our friends over at Strategas, I think, framed kind of the landscape around tariffs pretty succinctly, and I'll just kind of give you a quick summary of what they said. They essentially think that investors are broken down into two camps at this point. The first camp, it believes that tariffs are inflationary, as evidenced by some of the recent inflation data, which has been a little hot, which forces the Fed to stay on hold and possibly to raise rates in 2026. Under this scenario, tariffs have not increased inflation yet because inventories are still being drawn down. But once those inventories are worked through, then inflation will pick up more significantly. So that's kind of the first camp, the inflationary camp. Second camp believes the tariffs are deflationary and work like tax increases that reduce economic activity. And since the roughly $70 billion of tariffs that have already been paid are not really showing up in currency translation or inflation in any major way, that must mean that companies are eating the tariffs on their margins and will eventually reduce hiring. And under that scenario, the Fed needs to cut rates now to get ahead of the slowdown. So it appears that number two is getting more traction. The idea that we're less likely to see a huge inflation spike, more likely to get whatever inflation there is will be kind of retained by companies and possibly threatening to margins. Again, we haven't seen a lot of that recently. As I mentioned, Goldman Sachs just said this week they think that 70% of companies will pass along tariffs to consumers, but so far we've seen less of that and more of the possible threat to margins. And we've seen companies not look to hire people, right? And the jobs numbers really start to suffer. So we'll see which kind of narrative wins out, but it does seem that the market is more concerned with growth threats than inflation threats. The Fed's kind of in a tough spot, though, right? Because, I remember in 2018, they waited too long. They waited too long before cutting rates. They were waiting on an inflation figure that never came. And they were kind of late to the party. And that seems to be kind of what's going on right now. If you believe the bond market, and they often say that the bond market's the smartest guy in the room, the 2-year Treasury yield has always been considered a pretty good referendum on where the market thinks the Fed should be. Well, the 2-year Treasury yield is about 3.7%, right? That is well below the federal funds rate in the 4s. So the Treasury market is saying that the Fed needs to cut rates by probably at least a half, but maybe 3/4 of a point over the coming months. And the odds now of a September cut are almost 90%, according to the futures market. So, that's kind of where we are. That's kind of where we are, that growth concerns are trumping some of the initial concerns around tariffs, that they would be significantly inflationary. So, of course, we'll be watching all of this in the data. But there are some offsets here. There's certainly a positive side to this story that, of course, the market has been paying attention to, right? That's one of the reasons why the market's right around all-time highs. One of which is the tax bill, the one big beautiful bill, OBBB, as it has been called. A lot of the consumer aid in that bill is not really available till early next year. But the business aid is significant in the short term. Remember, there's significant changes to the way that a lot of research-oriented companies and CapEx-oriented companies can expense those things. Strategas estimates that it could add as much as $150 billion in new free cash flow to companies just this year, which is roughly 8 to 10% increase in free cash flow for S&P 500 companies. That's a big deal. Okay? We're very much aware, of course, of the incredible impact that AI-related spending has had in the economy. So just this quarter, Microsoft, Amazon, Google, and Meta spent a combined $95 billion in CapEx on our artificial intelligence-related spending. And they're ready to spend, according to their quarterly results, as much as $364 billion combined in this fiscal year. Well, before COVID hit, that would have been considered alone a huge fiscal stimulus package. So, you can't ignore that factor. In fact, Callie Cox over at Ritzold Asset Management, she came out with a really interesting chart this week that showed that AI has contributed more to the economy this year than consumer spending. Think about that for a second. I don't know if maybe that happened in the late 90s, in the lead up to the dot-com crash, but I don't recall a time where AI or any sort of tech-related investment blew away consumer spending. Now, you can make the argument that that's not healthy. Consumer spending was much higher last year, but it has been an offset. And I would argue that in a healthy economy, we get both. But so far, that type of spending combined with some of the cash flow relief from the tax bill have been enough to, quote unquote, sterilize any potential negative impact from the tariffs. So that doesn't mean that the economy won't slow down. It is slowing down and will continue to slow down. But I still think the odds of recession are not extraordinarily high, as some in the current financial media and headlines have been espousing. So, as mentioned at the top, I don't like to do too many deep dives into the economy because I think you can get lost in that and it really takes your eyes off what's actually happening in the markets. Because even if you're right on the economy, doesn't mean you're going to be right in the market if you don't realize to what degree the market is anticipating certain things or maybe has already discounted certain outcomes. But still, with all the news flow, I thought it was worth taking the time. As far as the market itself goes, as I said a few weeks ago, this is seasonally a soft patch. August and September are the two together, kind of the weakest time of the year for the market. Strategists noted that there's a difference, though, what the underlying trend looks like. If you go back to 1950, when the market was good, quote unquote, entering July, generally you've had flat performance over August and September. When the market was not so good, it's more like negative 4% over August and September. So, given that we have momentum the last few months, Strategas is basically saying the historical seasonal pattern would augur for sort of a flattish environment, which is kind of what we've had, right? Just in the last week, we've had a couple good days. We had a really bad day last Friday. It's been kind of mixed here over really since the beginning of August. I will say that a lot of institutional money seems to be behind the curve. That could be a tailwind later in the year. So if this keeps up, and the Dow's positive, the S&P's positive, the Nasdaq's positive, there are a lot of institutional investors, hedge funds, that are not having as great a year. And the folks over at Duality Research, which is a sort of a technical trading firm, they were noting there's essentially a $120 billion gap between current institutional S&P futures positioning and where it probably should be. That's their words. So essentially what they're saying is they need to play catch-up from a performance perspective. So don't be surprised if you see, a lot of big money coming into the market over the next 6 months, because none of these managers want to have a year where the S&P's up 7, 8, 9, 10% and they're negative, okay, or they're up 1%. Just a few other observations. Microsoft joined the $4 trillion club in market capitalization in the last week alongside NVIDIA. Apple, Amazon, Alphabet, and Meta could be next. Just to kind of put that in perspective, NVIDIA and Microsoft, if they were countries, they would have the fourth and fifth largest GDPs in the world, respectively. NVIDIA alone is worth the equivalent of 14% of U.S. GDP. I mean, think about that for a second. This data is according to FactSet. And then if you look at it from kind of a market perspective, NVIDIA's S&P 500 weight is almost larger than the healthcare sector and almost larger than the industrial sector. Think about that for a second. NVIDIA's market cap is worth more than all the other healthcare stocks combined. Merck, right? Bristol Myers, Pfizer, AbbVie, Eli Lilly, add them all up. Less of a market cap than NVIDIA. That is absolutely stunning. So obviously there's a lot of concern about market concentration. It's really hard for me to say, that these stocks are undervalued or overvalued, right? Because just the market, it's just like when the internet came out, when the cell phone came out, it's very difficult to know how big of a market you're actually dealing with because it keeps expanding, right? And by market, I'm talking about artificial intelligence. So it's hard for me to say that some of these names like NVIDIA are expensive because if you track the multiples on these stocks alongside their earnings contribution to the market, there's not much of a detachment there. So in other words, in many ways, the earnings contribution to the market justifies these types of valuations, this type of market share. But I do think it's very important for you to understand what you own when you're looking at your portfolio because the 10 largest weights in the S&P 500 are just a hair under 40% of the S&P 500 now. Top 10 make up 40% of the S&P. That's about a 45-year high, according to Strategas. So think about that for a second. And then if you look at, I'm not going to get into specific names, but if you look at one of the largest growth ETFs, those top 10 names make up almost 59% of it. NASDAQ, almost 49% of it. I've seen some momentum ETFs that are, 30 to 40% of those are occupied by the top 10. So I say this because if you have a mutual fund portfolio or an ETF portfolio or even an individual stock portfolio, it's very possible that your entire portfolio is really driven by a handful of stocks. And it's also very possible that if you think you're diversified, a lot of these funds own the same stuff, which again has not been a bad thing recently, of course, but there's a flip side to that, right? We saw what happened in April when all those names were clobbered by 30%. You were probably, if you were in that camp, you were highly correlated with that downside. Now, of course, we've snapped back, no harm, no foul, but maybe that isn't always the case. So just know what you own. Know what you own. I think that is very important. And I also tell you, just because AI has been such a lift to the S&P recently does not necessarily mean the rest of the market is extended. So the Dow, for example, which is a little bit more of a representative of the broader market, the Dow has not made a single all-time high this year. Not a single all-time high. And if you look at the value line index, which is sort of an equal weighted index of the market, has not made an all-time high since 2021. So I don't think it's fair to say that everything in the market is extended. Now, the market's not cheap, but I don't know that it is as extended as you might think because a lot of the multiple expansion, valuation multiple expansion, has come from the top, the biggest 7 names. We've seen very little multiple expansion for the other 493 stocks in the S&P. Now, granted, those other 493 have also had a lot less growth, about 2% earnings growth this quarter, according to FactSet, versus double digits for the Mag 7. But again, I think it is a little misleading to say that the market is runaway expensive, the market's overextended, and as I mentioned a couple weeks ago, the type of surge in momentum that we've had since April is generally suggestive of higher prices over the next 12 months, not lower prices. Okay? Now, there's often a period of consolidation, and as I said, seasonally, this is a soft time, so anything can happen here the next 2-3 months. But for all these reasons, I still think there's reasons for optimism over the course of the coming 6, 9, 12 months, particularly if the lift in some of the tariff uncertainty does in fact lead to more economic activity, even if tariff rates are 5, 6, 7 times higher than they were in January. So we'll see. As I've been freely volunteering over the course of the last 6 months, I have more questions than answers. Anybody who has more answers than questions is trying to sell you something because there's still a lot of uncertainty as to how this is all going to turn out. But stick with me. Up next, I want to transition. I've got a few more minutes. Do want to highlight the latest that I'm hearing from some of the top holdings in our portfolio. Back in a minute. The Magnificent Seven have become the Lagnificent Seven. The clear leaders of the past 2 years are now bringing up the rear. Is this just a correction or something worse? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. I do want to highlight what I'm hearing from a few of the top holdings in our portfolio. When I say portfolio, the names I'm mentioning are names that we own for many of our clients. I also own all these names personally, so you can consider that a conflict of interest. If you are a client, I think you can feel comfortable. We've done our due diligence and feel they're appropriate for your particular portfolio. If you're not a client, please make sure you do your own homework, your own research. Make sure that they work for your particular situation. Apple has been very much in the news, including a very prominent photo op with Tim Cook, the CEO, in the Trump administration. I guess that was Wednesday afternoon, I should say. Essentially, Apple committed, they had already committed to invest about $500 billion back into their supply chain here in the U.S. They added $100 billion to that. So they're now going to invest, according to Tim Cook, $600 billion primarily in their screen assembly, some of the glass that goes into that. And it's a very interesting situation. Remember, years ago in the first Trump administration, Apple had rerouted a lot of their manufacturing from China to India. Well, really at the request of the Trump administration. But of course, now India is facing 50% tariffs. So Apple was in a very tough situation. But it appears, some of this is behind closed doors, but it appears that Apple has worked out a very favorable situation where, based on their commitment to put more money back into the U.S. manufacturing, they are going to be specifically exempted on a company level from that tariff rate, that India tariff rate. And more broadly, some of the tariffs that Trump wants to put on the import of semiconductor chips. That's a big deal. Remember, that's been a big overhang on Apple stock. Apple has been a lousy stock this year, let's be honest. Coming into this week, Apple was down almost 20% for the year. Of course, it's been very strong over the past 5 years, but this year it has not been strong. And one of the big reasons was their tariff risk. I don't want to say that those risks are off the table, but those risks have dropped a lot, and the stock responded this week with a decent performance. Really, the second big drag on Apple has been their innovation. They've been pushing back kind of their installed AI capability really for over a year now. And as a result, if you're like me, you've been sitting on your phone. Unless you need to have a bigger camera every year, a more powerful camera every year, you might be sitting on a 3, 4, 5-year-old iPhone, right? But if there's a real technological innovation, that's going to precipitate a major upgrade cycle. And that's kind of the next shoe that needs to drop in a positive way to get Apple back to being a good performer. The analyst at Raymond James took a look at their quarter and were pretty bullish. The iPhone demand actually held up quite well, including much better results than was expected from China. China has been a sore spot, actual sales in China. That was better than expected. The big bright spot, and this has been the bright spot for several quarters, has been their services segment. The App Store, Apple Pay, the music library, very strong results on the services side. Because remember, regardless of whether people are upgrading their phones or not, chances are they're keeping their existing phone, right? And there are over 1 billion phones in existence in the world. People are paying for those services, and Wall Street likes recurring revenues. They tend to pay up for recurring revenues. I think the negative in the quarter was that it did look like people pulled forward some activity, some buying into the first quarter of the year, thinking that prices were going up. So maybe the iPhone numbers were not quite as strong as indicated, but still the service revenue, which is theoretically unaffected by tariffs, was quite strong. So the risks there, I think, are kind of on the innovation side at this point. I think some of the trade-related risks have been reduced. Can Apple come out with a phone that makes people say, you know what, I've got to have that. I need that to be competitive, to run all the AI applications I want to run. The valuation is still somewhat demanding too. They're trading over 30 times earnings, but again, it's not super expensive versus the range of the last 3 years. So take a look at Apple. I think it's a little bit of a wait and see over the next 6 months, but considering that they've underperformed this year with a double-digit loss, maybe there's some room for Apple to sort of take a year off, but set the table for better performance in 26 and 27. I think it's an interesting story. Berkshire Hathaway has also been in the news. We all know that Warren Buffett announced that he is stepping down. He announced it, I guess it was in May, and I guess he's stepping down sometime next year. He's sort of staying on right now as sort of a consultant. Stock hasn't done well since he announced that. When the market was getting killed in April, Berkshire was outperforming, but since that time, stock's down about 10%. And it's not just the Warren Buffett factor. There have been other issues. Property and casualty insurance cycle may have peaked. They haven't done much. Not a lot of investment activity. They haven't bought back any stock. So there isn't a lot of sort of short-term catalysts to drive Berkshire. But, has Berkshire Hathaway ever been about short-term performance? I mean, it's always been a long-term situation. And I've been following Berkshire Hathaway for 30 years. Whenever people say that Berkshire Hathaway's, behind the curve, that they're inactive, they're sitting on too much cash, that's often the time to get interested. I think for a long time, there was a premium built into the valuation on Berkshire Hathaway because of Buffett. I would argue, though, that hasn't really been there for the past 10 years. I mean, outside of Burlington Northern, which was over 10 years ago, and maybe Precision Castparts, Buffett hasn't made any huge deals in a long, long time. So this idea that there was this Warren Buffett premium built into the stock doesn't really show up in the numbers. I mean, they're trading roughly 1.6 times book value. They were up to 1.8 times book value in April. Long-term average is about 1.5 times. So trading at a discount to where it was a few months ago, roughly in the same neighborhood as where it has been over the years. So I don't think it's fair to say that they've lost some sort of premium. And I think according to UBS, who has a buy rating on the stock, UBS thinks that by the end of this year, they'll be closer to about 1.4 times book value and arguably cheap relative to their valuation. So Berkshire might be getting back to a value stock. I would also say these are the levels at which these types of valuations are the levels at which they have previously bought back stock. Remember, they have over $330 billion in cash. Plenty of ammunition, dry powder to buy back their own stock if they want to. And just remember, we've been in sort of a risk-on rally here the last few months where the more cyclical names, the meme stocks, the AI stocks have done well. A lot of the more defensive names, healthcare, consumer staples, utilities, haven't done anything. In fact, they've lost money in many instances. I would put Berkshire kind of in that camp. It would not surprise me at all, and this is not a prediction, it's just I wouldn't be surprised, if we did encounter some more turbulence in the markets at some point. Berkshire could easily outperform. If you look at their most recent quarter, I think the numbers were a little bit skewed by foreign currency translation. If you back out the effect of the dollar and how they translated back some foreign earnings, they actually had operating earnings growth of almost 8% quarter over quarter, which is certainly much better than what the headlines suggested. Buffett has been saying for some time that property casualty insurance rates cannot go up at the same pace that they've been going up the last few years. And that showed up in the numbers, some moderation in pricing. But I think that was well accounted for in estimates. And I think you have a more rational forward guidance on the insurance division than you did. So we'll see. Obviously, with the new CEO taking over early next year, we'll see if there's any changes in terms of how they think about share buybacks, how they think about potentially paying a dividend, how they think about deploying cash. But I think Berkshire Hathaway could arguably be cheap at this point. I think the big risks for Berkshire are not really operational risks because they've had kind of the same types of investments really for the last 10 years. Not a lot's different in terms except for a little bit of their stock portfolio. So there's always some market risk there. I think it's more the transition risk. How successfully can Greg Abel, the new CEO, communicate, deliver a message to Wall Street that makes Wall Street comfortable with the direction? Can they keep Ajit Jain, who's been running their insurance business? Can they retain him? Those are the open questions. It's more transition, management, strategy questions, more so than operational questions, in my opinion. Hopefully we get some answers over the next few months, but if you don't own Berkshire, it might be worth taking a quick look. Running out of time here, I do have one more. I know some of our clients are not fans of big oil, and I appreciate that. But energy is, I think, worth taking a look at. Do you know that for the energy sector in the S&P, it's been 11 years since their last new all-time high? And that's insane. Over a decade since they hit an all-time high. And if you look at mutual fund and ETF inflows and outflows, energy has had the most outflows of any sector since the S&P 500 low in October of 23, basically 2 years ago. So, and I think a lot of people got suckered into this, right? Because I think a lot of people mistakenly thought that President Trump would be more pro-fossil fuels, and I think he is, but that means more supply, right? So there's been downward pressure on energy prices. But Chevron has been a pretty strong operational story. It's interesting. The big oil companies seem to be focusing less on growing the top line these days, a little bit more on shoring up the bottom line, which is an interesting transition because it used to be the opposite. They used to want to drill everywhere, spent a ton of money, and end up having bloated balance sheets, terrible margins whenever oil prices fell. That's not really the case right now. And if you look at Chevron's most recent quarter, a couple things are going on. Looks like they're going to be merging with Hess, right? Exxon and Chevron were kind of fighting over Hess. Well, Chevron's going to move forward with that deal. And they now expect, this is according to the Raymond James analyst, a full $1 billion in annual run rate synergies. That was 6 months earlier than what they had said earlier in the year. They expect cash flow to be accretive in the fourth quarter of this year, which again is earlier than what they had previously communicated. They're cutting about $2 to $2.3 billion in costs by the middle of next year. And as such, their free cash flow guide for next year has gone from about $10 billion up to almost $13 billion. And what are they doing with that? They are buying back a ton of stock. So this is a leaner, meaner Chevron than what we've seen over the past 5 years. Remember, they already pay about a 4.5% dividend. They'll be buying back a lot of stock. The risks to Chevron are kind of obvious. It's mostly macro risks, around oil prices. What is OPEC going to do? What's going to happen with India buying Russian oil? All these things, right? But I think Chevron is putting themselves in a position where they can be profitable and generate a lot of free cash flow at a lower oil price point than maybe they would have said 2 or 3 years ago. So given how out of favor the sector is, might be worth a look. Lastly, I just wanted to touch on Uber, which is a relatively new addition to the portfolio. Came out with their earnings this week. what really kind of blew me away is their delivery business, which gets a lot less attention than their ride business. Their delivery business, the numbers on that, both the bookings and the margins were much better than Wall Street expected. And there's a lot of synergy, something like, according to Deutsche Bank, 2/3 of delivery customers have also taken rides with Uber. So I think Uber is going to do a lot to tie those businesses together and cross-sell those services. The other thing I would say is they're getting some really good traction in their autonomous vehicle business. Very high utilization levels with Waymo, for example, which is Google's autonomous driving division in Atlanta, Austin. A lot of eyes on future markets. They're just launching in Dallas. And remember, Uber has sort of an unmatched ability to drive scale and positive economics, so their infrastructure leads them into all kinds of partnerships with Waymo and as well as hardware, Lucid, Toyota, the actual car manufacturers themselves. So the thing about Uber is it's not an expensive stock. There are very few companies in the S&P 500 that can deliver their revenue growth, double digits, and double digits earnings growth, yet still trade, in the low teens on a price to EBITDA multiple. So very few companies like that in the S&P. So yes, there are risks from sort of a competitive standpoint. We all know Elon Musk and Tesla, they're trying to be disruptive in those markets as well. But I like Uber's positioning and the fact that they have so many strategic partnerships underway and still to come that I think gives them such a good footprint. So again, risks to all of these as there are risks to the overall market, but those are some names that kind of stood out for me here in the last week. Obviously, there are others. Next time, I'll bring you more. So I hope that was helpful. I know we covered a lot, and I hope to have more answers to these open questions as we do these podcasts in the coming weeks and months. Stay healthy. Enjoy the rest of your summer. And as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.